So, let us continue from where we left off before the break. Before the break I mentioned that as far as YTM goes, we make two fundamental assumptions, one implicit, one explicit. The implicit one is that all intermediate cash flows are reinvested at the YTM rate, and explicitly we assume that the bond is held by the investor or is to be held by the investor up to the maturity of the bond. In other words, the investment horizon coincides with the bond's maturity. Now, as a consequence of these two assumptions, what we find is that in the event that intermediate cash flows are not reinvested at the reinvestment rate, or the investor's horizon does not coincide with the bond's maturity, the YTM of the bond may not give you the correct picture insofar as the yield on your investment is concerned. Let me illustrate this with an example. We have two bonds A and B. The coupon rate of A is 10%, the coupon rate of B is 3%, face value of both of them is 100, and the price is 138.90 and 70.22 respectively at the end at t equal to 0, that is today, and the maturity of both the bonds is 15 years, and you are going to hold the bonds up to their maturity. The frequency of coupon payments is annual in both cases, and what the YTM, if you work out on these parameters, you find that the YTM of bond A turns out to be 6% and the YTM of bond B turns out to be 6.1%. Therefore, it is clear that if YTM was to be the deciding criterion, then bond B would be the superior investment compared to bond A. But we now add one more data to our problem, and we assume that the reinvestment of coupons during the life of bond A as well as that of bond B is at 6.66%. Then we, with this additional assumption, let us examine whether which is the better investment. If we do so, the reinvestment rate is 6.66%. Coupon rate, remember, for A is 10%, for B is 3%, and the final value or the terminal value of all the reinvested coupons, if we work it out at the reinvestment rate of 6.66%, we find that for bond A it turns out to be 243.6823, and for B it turns out to be 73.10469. Let me repeat, this is the fine maturity value of all the coupons that are received by the investor during the life of the investment of 15 years, and they are reinvested not at the YTM rate, they are reinvested at the rate which is given to us, which is 6.66%. I reiterate, the investment is of the coupons is at 6.66% and not the YTM rates. So, add to that the redemption value of 100 and we get the total cash flows for bond A at t equal to 15 years, that is the end of the that is on the date of maturity of the bonds. For A it is 343.6823, for B it is 173.10467. The current market price, let us recall, is 138.9 for A and 70.22 for B. When we work out the effective annual yield, we find that the effective annual yield for A is 6.22%, for B it is 6.199%. So, clearly, notwithstanding the fact that the YTM of B was higher than the YTM of A, the effective annual yield of A tends to be higher than B. Why is that? Because the reinvestment rate, actual reinvestment rate or projected reinvestment rate happens to be different from the YTM. The projected reinvestment rate in our case is 6.66%, it is given to us. However, if we assume the YTM rate, then A's coupons would have been invested at 6%, B's coupon would have been invested at 6.1%. And now the reinvestment rate of both the coupons is 6.66%. And because A's coupons are more, the coupon rate of A is 10%, that means every year you are getting a coupon of 10, whereas in the case of B you are getting a coupon of 3. Therefore, the amount that is reinvested in the case of A turns out to be more, the rate is more, and therefore, the effective annual yield turns out to be more for A compared to B and compared to the YTMs of the two bonds. This is a table which shows you the effective annual return or the effective annual yield corresponding to various reinvestment rates. At 6%, you find that the return or the effective annual yield is 6% for A, 6.08% for B, and in fact up to 6.6% reinvestment rate, we find that bond B continues to be superior than bond A, but once we at 6.66% and thereafter we find that bond A turns out to be superior than B. I repeat, this is because of the higher coupon rate of A, which means higher investment at this higher reinvestment rate, and therefore, a higher effective annual yield, higher terminal value of coupons and higher effective annual yield. The second problem with YTM is rather more technical. It means it says that the YTM of a portfolio, is not equal to the weighted average of the YTM of the constituent securities. Let me repeat, the YTM of a portfolio is not equal to the weighted average YTM of the constituent securities, and this makes it YTM an incompatible measure of return insofar as the portfolios are concerned, because as far as the expected returns are concerned, the expected return on a portfolio is equal to the weighted average of the expected return of its constituents. However, the YTM of a portfolio is not equal to the weighted average YTMs of the constituent securities. So, a quick recall about the relationship between coupon, YTM and price. Bond prices and YTM are inversely related. This is quite obvious from the formula. The value of a bond would be equal to the face value only. This applies to the conventional bond which is redeemed at par and has a level coupon. The value of a bond would be equal to its face value only when the coupon, interest rate and YTM are equal. The value of a bond would be higher than the face value when the coupon, interest rate is more than the YTM and vice versa. Now, we talk about yield curve for coupon bonds. Now, a yield curve for coupon bonds shows the YTMs for coupon bonds at various terms to maturity, e.g. the 1 year T bond, the 2 year T bond and so on. Please note the coupon rate is irrelevant. I have been saying that again and again. The YTM is a risk adjusted rate. So, if you are talking about T bonds, it would be the risk free rate, but the important thing is that it is a rate which depends on risk. It does not depend on the coupon payments. The price adjusts itself in tandem with the pattern of coupon payments corresponding to a given risk profile. So, coupon rate is irrelevant. YTMs will not depend on coupon rates, since for a given risk the prices will adjust corresponding to different coupon rates, keeping the YTM unchanged. And this is very fundamental. However, YTM depends on the riskiness of the instrument. Yields are calculated for several maturities, and yields for bonds with maturities between them are estimated by linear interpolation, more of a procedural issue. This is an example of a spot curve. This is an example of the curve that is based on for coupon bonds, that is. As you can see here in the right hand panel, and this is an upward sloping yield curve, and the figure shows an upward sloping yield curve for coupon treasury bonds constructed from yields on yields. Please note yields, YTMs, 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year and 30 year maturities. So, and there is no mention about coupon rates here. Please note this fact, because the YTM does not depend on coupon rates. Par bond yield curve. What is par rate? I mentioned a little bit about par rates in an earlier lecture. Let us recall the par yield on a certain bond maturity is the coupon rate that causes the bond price to equal its par value. It is the coupon rate at which the hypothetical coupon rate, not the actual coupon rate, it is the hypothetical coupon rate such that if that were the coupon rate on the given instrument, the instrument would be trading at par value. So, let me read it out again. The par yield on for a certain bond maturity is the coupon rate that causes the bond price to be equal to its par value. Alternatively, please note, for a par bond, for a par level coupon bond, the coupon rate is equal to the YTM. So, this definition that I mentioned just now can also be related to the YTM, and we can say that par rate can be viewed as the YTM of a bond at each maturity. I repeat, for a par bond, the coupon rate and YTM must be equal, and therefore, we can also describe or we can also define the par rate in terms of the YTM, as it can be viewed as the YTM of a bond at each maturity. This is how we calculate the par rate. The C is the coupon rate, which will incidentally turn out to be the par rate, and we solve the equation that we have here. This is a familiar equation, simply represents the intrinsic value of the instrument, and but when the important thing is the left hand side. The left hand side is this C will be the coupon rate. The C will be the coupon rate if the value of the bond, that is the right hand side, equals the face value of the bond or the par value of the bond. In other words, if the bond is quoting at par, it is that coupon rate, it is that value of C such that the valuation on the right hand side turns out to be equal to the face value of the bond. In other words, it is such that the bond is quoting at par. So, C constitutes the par yield on the bond. A plot of the par yield with maturity is a par curve. A plot of the par yield along the y axis, maturity along the x axis gives you the par curve. Par bond yield curve or par curve is not calculated from yields on actual bonds, but is constructed from the spot curve. As you can see here from this formula, all we need is the spot rate and the spectrum of spot rates corresponding to the cash flow pattern of the bond, and we can work out the value of C at which the bond is quoting at par. This is an example which illustrates what I have just talked about. Consider the following spectrum of spot rates: S01 is equal to 3%, S02 is equal to 4%, S03 is equal to 5%. Calculate the 3-year par rate. So, we assume that the par rate is C, then the value of the bond by discounting the future cash flows. What are those cash flows? C for the first year, C for the second year, and C plus 100, assuming the face value of 100, it is C plus 100 for the third year redemption at face value. The first C, that is C corresponding to the first year, is discounted at the first year spot rate, which is 3%. The second C, that is the coupon payment at the end of the second year, is discounted at the 2-year spot rate, that is 4%, and the third payment of C plus 100, that includes the redemption value of 100, will be discounted at 5%, that is the 3-year spot rate. And what is this has to be equal to? What has this got to be equal to? This has got to be equal to the face value of the bond or the par value of the bond. On solving this equation for C, what we find is the C is equal to 4.9347%. So, this is quite simple, but this is how the par rates can be calculated from spot rates or vice versa as well. When the 0 curve is upward sloping, as it is in this case, you can see here S01 is 3%, S02 is 4%, S05 is 5%. So, clearly the spot curve is upward sloping. The spot rate for a given maturity, for example, we have a maturity of 3 years, the 3-year spot rate is 5%, and this is greater than the par yield for that maturity, which is 4.9347%. So, given an upward sloping yield curve, the spot rate for a given maturity exceeds the par yield corresponding to that maturity. Forward rates I have discussed in a lot of detail earlier, so I will not spend time on it. Forward rate yield curve. A forward rate yield curve shows the future rates for bonds or money market securities for the same maturities for annual periods in the future. So, for example, we typically have the forward curve that shows the yields on 1 year securities for each future year quoted on a semi-annual bond basis. A typical illustration is a curve which shows 1 year maturity rates for an investment which begins at t equal to 1 year, investment begins at t equal to 2 years, that is from 2 to 3 years, firstly from 1 to 2 years, then 2 to 3 years, then 3 to 4 years, 4 to 5 years and so on. So, these are 1 year forward rates which commence at different points in the future 1 year apart. I repeat, we have we work out the forward rate for F12, that is the investment initiating at t equal to 1 and terminating at t equal to 2, then F23, that is investment initiating at t equal to 2, terminating at t equal to 3, and similarly F34, F45 and so on, and we plot these rates F12, F23, F34 against the corresponding points in time, that is the forward rate curve. Now, we talk about yield spreads. What are yield spreads? A yield spread is the difference between the yields of two different bonds, one of which is usually a benchmark bond. So, there is little to explain here. Let me repeat, a yield spread is the difference between the yields of two different bonds, one of which is a benchmark bond. The benchmark spread, a yield spread of a given bond, given risky bond with reference to a benchmark bond is known as a benchmark spread. Similarly, a G spread, a yield spread over a government bond is called a G spread. So, if you have a risky bond and you have a benchmark bond, the YTMs, I repeat, the YTMs or the difference in YTMs between these two bonds gives you the yield spread or the benchmark yield spread. If the benchmark bond is a government bond and you have another risky bond, the difference in YTMs between these two bonds is called the G spread. Let me repeat, you have a risky bond with you, you have a benchmark bond with you, which you may choose as the treasury bond or the LIBOR or whatever. But the basic thing is the YTM between these two bonds gives you the benchmark spread. If that benchmark bond is a government bond, is a T bond, is a government treasury, then the difference between the YTM of the risky bond and the YTM of the government bond gives you the G spread. For fixed coupon bonds, on the run with the most recently issued government securities, the government bond yields on the run securities means the most recent securities that are available in the market. The yields on those securities are usually used as the benchmarks. So, for fixed income bonds on the run, government bond yields for the same or nearest maturity are frequently used as benchmarks. But you see, the basic thing is benchmark is a broader term. It may include some other benchmark that may be relevant to your investment. For example, in the case of the floating rate bond, we use the LIBOR as the benchmark. However, for fixed income bonds, we use the most recent traded government securities of equivalent maturity as the benchmark. That is a common practice. If example, if a 5-year corporate bond has a yield of 6.25% and its benchmark, the 5-year treasury note, has a yield of 3.50%, then the corporate bond has a benchmark spread of even you can also call it a G spread in this particular case of 275 basis points. The spreads, that is the benchmark spread or the G spread, are usually represented in basis points. The benchmark spread may change during a bond's life. For a 5-year corporate bond, when issued, the benchmark spread is stated relative to the 5-year government bond yield. This is quite logical also. The basic thing is the remaining maturity of our bond, the bond whose spread is going to be worked out, that has to be compared, or that is the relevant maturity insofar as the benchmark bond is concerned, not the total life of the bond, not the life of the bond at the point of issue. It is the remaining life of the bond, the remaining tenure of the bond, the term to maturity as of today, as on the date of comparison, as on the date of calculation of the spread which is relevant. So, that is what this statement says, that if the bond has a remaining maturity of say 3 years, it is a 5-year bond, but it has a remaining maturity of 3 years, then the benchmark should be a T bond of maturity of 3 years and not 5 years. Yield spread for floating rate bonds, as I mentioned just now, floating rate securities typically use LIBOR as a benchmark rate, London interbank offer rate. Utility of benchmark spread. What is the interpretation of benchmark spreads? What is the interpretation of yield spreads rather? That is interesting, but quite simple. Yield spreads are useful for analyzing the factors that affect a bond's yield. If a corporate bond yield, this is an example which illustrates the interpretation of yield spreads. If a corporate bond's yield increases from 6.25% to 6.50%, this could have been caused by factors that affect all bond yields, that is macroeconomic factors, firm specific or industry specific factors, that is microeconomic factors. So, if a corporate bonds yield increases, for example, the increase could be due to macroeconomic factors or it could be due to microeconomic factors. For example, if this increase from 6.25% to 6.50% is accompanied by an increase in the yields, it is accompanied by no change in the yield spread, that means what? That means the benchmark yield has also increased by the same amount. Let me repeat, if this increase from 6.25% to 6.50% in the corporate bonds yield is accompanied by no change in the yield spread, that means what? That means the benchmark yield has also increased by the same amount. That means what? That means the increase is due to macroeconomic factors. On the other hand, if the benchmark yield remains the same and the yield on our instrument, that is this corporate bond, has increased from 6.25 to 6.5%, it means that the bond's riskiness has increased. It is due to factors which are specific to this instrument. Why? Because the benchmark yield has not changed. The benchmark yield has not changed. Therefore, because the benchmark yield is indicative of the macroeconomic factors, the macroeconomic impact is not prevalent, is not there insofar as the change in yield on our corporate bond is concerned. In other words, the change in yield on the corporate bond is due to factors that are intrinsic, that are internal, that are relevant solely to our corporate bond. So, let me read it out for you. If a bond yield increases, but the yield spread remains the same, that means what? That means the yield on its benchmark must have also increased, which suggests that macroeconomic factors cause the bond yields to change in general, to increase in general. However, if the yield spread increases, that means the benchmark yield is not changed, and if the benchmark yield does not change, that means what? That means the change in the yield in our corporate bond is due to microeconomic factors. Let me repeat once more, this is very important. If there is an increase in the yield in our instrument, in our corporate bond, let us say from 6.25% to 6.50%, there could be two situations. Number one, the yield spread remains the same. If the yield spread remains the same, that means what? That means the benchmark yield has also increased. If the benchmark yield has increased, it is due to macroeconomic factors. On the other hand, if the benchmark yield remains the same, that is the yield spread has increased, benchmark yield has not changed, that means the change is due to change in factors which are intrinsic or internal to our corporate bond. Z spread and option adjusted spread. Now, this Z spread is very interesting. You see, when I talked about the G spread and the benchmark spread, I explicitly mentioned the words YTMs. Yield, wherever the word yield was used in the context of the G spread and the benchmark spread, I refer to them as YTMs. And what is the property of YTM? YTM is one single rate that encapsulates the entire spectrum or that encapsulates the impact of the entire spectrum of spot rates. In other words, it assumes, in some sense, it assumes that the yield curve is flat. It does not account for the change in the shape of the yield curve explicitly. So, that is the important drawback of the benchmark spread and the G spread. In the Z spread, that is the zero volatility spread, Z means zero volatility. So, zero volatility spread, what we try to do is, we try to eliminate this fallacy or flaw in the G spread. How do we do it? I will come to it. Let me read out this slide first. There are three sources that create uncertainty in the cash flows from investment in a bond. Number one, possibility of default, that is the credit risk in the bond, possibility of default by the issuer insofar as payment of interest and redemption of principal is concerned. Number two, in the case of option embedded bonds, bonds that are callable or puttable or have some other complex option attached to them, there is the optionality risk or the risk of possibility of exercise of the option. Changes in interest rates also result in, or the possibility or the prospect of changes in interest rate during the life of the investment in a bond in a fixed income security also give rise to a certain amount of risk, that is called the interest rate risk. The issue of interest rate risk I will talk about in a lot of detail in subsequent lectures. For the moment, let us focus on credit risk and optionality risk, that is this point 1 and point 2. The first source of risk is captured by the zero volatility spread or the Z spread, and the second source of risk is captured by the option adjusted spread. Now, how do we work out the zero volatility spread? The important thing is, I reiterate, when I talked about benchmark spread and G spread, I talked about YTMs. When we talk about YTMs, we talk about a single interest rate. We do not talk about the entire spectrum of interest rates. That single interest rate is deemed to encapsulate the entire information contained in the spot rate, but obviously there is a loss of information when we use one number to represent the entire spectrum of spot rates. To obviate this problem, to remedy this flaw, we have this zero volatility spread. What do? To each, we first of all we identify the spectrum of benchmark spot rates. We identify the spectrum of benchmark spot rates. These are the benchmark spot rates, right. Then what we do is, we add to each of these benchmark spot rates the same quantity, a single constant, in this case it is delta in this expression. So, to each, no, delta is an unknown quantity, please note this point. Delta is something which we will work out as part of this equation, and then we will say that this delta is what we call the Z spread. Let me repeat, we have the entire spectrum of benchmark spot rates, that is, for example, the T bond rates or the risk free rates. We add to each of them a quantity delta, and we discount all the futures cash flows arising from the bond at the respective spot rates plus this delta. For example, C1 will be discounted at S01, let me write it down. C1 will be discounted at S01 plus delta. C2 will be discounted at S02 plus delta, and similarly Ct will be discounted at S0t plus delta, but we do not know what delta is. How do we find out delta? We find out delta by equating the aggregate of these discounted values to the current market price of the bond. So, I repeat this, these are benchmark rates, these are not the risk adjusted rates, these are risk free rates or benchmark rates. Let me add a subscript B to them, B. All these are benchmark rates, as you can see here, this B is here. So, this B represents that these are benchmark rates. You add to each of these benchmark rates a quantity delta, and then you discount all future cash flows at S0t plus delta, where t ranges from 1 to capital T, and then you equate this right hand side to the current market price. This is an equation in one unknown. What is that unknown? That unknown is delta, and you can solve this one equation in one unknown and you get the value of delta, and this delta is called the Z spread. So, let me read it out. G spread essentially involves comparing the YTM of the given bond with the YTM of a G bond, government bond with corresponding maturity. The G spread assumes that the spot yield curve is flat, because it says only one figure here, that is the YTM figure. So, that yields are approximately same across all maturities. Normally, however, the spot yield curve is upward sloping, that is, as you go into the future the spot yields increase. So, spot yield curve is upward sloping, that is, long term yields are higher than short term yields. In the Z spread or the zero volatility spread or the Z spread, we add an equal amount, this delta, to each benchmark spot rate, what S B 0t. So, add an equal amount delta to each benchmark spot rate S B comma 0t and value the bond with these rates. Work out the valuation by discounting the future cash flows from the bond at the respective spot rates plus delta. When we find that delta such that these discounted values on the right hand side equal the current market price of the bond, we get what is called the G spread. So, when we find an amount which, when added to the benchmark spot rates, produces a value equal to the market price of the bond, we have the appropriate yield curve spread. The Z spread accounts for the shape of the yield curve. In other words, what we have done here is, let us try to understand. You see, let us look at a upward sloping yield curve. This has certain, this is the government or the riskless upward sloping yield curve of T bonds or riskless bonds. So, this will give you the various values of S 0 T, okay, or rather with the benchmark S B 0 T. You will get all the values of S B 0 T from this government spot curve relating to government rates. Now, what I do is I lift it up with parallel to itself. I lift up this curve parallel to itself by a certain amount delta, such that when I lift up this yield curve parallel to itself by delta and I use these new rates corresponding to this curve for discounting my cash flows, what I get on the left hand side is the current market price of the bond. That will give me the value of delta, and that is what is called the Z spread. I will continue from here in the next lecture. Thank you.